All right, so how's the secondary FBN market performed since the lifting of this one-year restriction on foreign ownership of government securities?
Well, I think the market has actually performed quite well. I believe the announcement came out sometime on Thursday the 23rd after close of trading. And the next day, Friday 24th, the market, the yield on the 5-year benchmark April 2015 bond improved 32 basis points. And since then, it's moved up again another 50 basis points. So a total 82 basis points movement to about 11.94. So that's a big jump in the less than 2 weeks since the announcement was made. Right. Some of the other maturities have not done as well, but overall yields have dropped.
I mean, we are seeing Egie, the Naira coming in at around 152.47, somewhere in that region. And it's believed that with increased capital flows, because of the lifting of these restrictions, the Naira is going to get a lot stronger. Is that the only reason that's going to support the Naira, or do other variables come into play? Things like inflation, things like government spending, the debt ratio?
Well, I think in terms of those rates, obviously the foreign inflows might have an impact. But there are a lot of local variables that have moved those rates. The CBN changed the rules on funding of BDC's Bureau de Change, which effectively cut out a big chunk of the official demand, which is why the demand in that market fell and the rates moved up. But when you look at the parallel market, which is the kind of the autonomous market, rates there have moved up very significantly. We're now at about 163. It's a long time since we've had this kind of 10 naira spread on the dollar between the official CBN market and the autonomous market. So clearly there's some policy restrictions that are moving the rates in the official market differently from the parallel market.
Right. All right, talk to us about your expectation for the bond auctions, July 20th for the Debt Management Office.
Yes, I think the July 20th auction will be a bit interesting because the past few months have just had a 3 and 5 year. Now 2018 May bond, which has 6 years, 11 months left, which effectively makes it a 7-year benchmark, is being introduced. So in total, we could go as high as 85 billion in auction compared to 70 billion last month, depending on how much is issued on the 3 and 5 year. But given where the 5-year secondary market is trading now at about 11.94, it's possible to expect that given the only about 25 billion being offered by the DMO, the 5-year rate should be around 12. And then this new 7-year benchmark should be slightly higher.
Yeah.
So obviously it all depends on the amount of liquidity at that point in time in the market. But for sure, the current secondary market rates will drive those final auction prices.
The Euro bond that Nigeria launched last year, $500 million. Track for us its performance. Apparently the yields are at an all-time high.
Yeah, in terms of the price at an all-time high, I believe, yielding about 5.89 compared to a yield of about 6.9 earlier in the year. So clearly, people who got into that bond early have made significant gains. Somebody might argue that it's also a proxy for the way the international market sees the post-election activities of the president. Hopefully, those rates are sustained. Obviously, it's a good indication for new issuers in the Eurobond market. Because the sovereign benchmark has improved. Same for the local market. With the FGM bond rates on the 5-year under 12, it certainly is definitely a good benchmark for which new issuers can work.
Let's talk about May inflation figures, 12.4. June inflation coming out soon. What do you think is going to happen? Because we had thought early in the year that inflation was on the decline, and now we've seen it ticking up a little bit. Yes,
the inflation one is a bit of an anomaly because yes, MPR has gone up significantly this year. It's now at 8%, but inflation hasn't really moved down on a sustained basis. It's changed significantly month to month. So yes, 12.4 in May, June. We really don't know where it could be. Hopefully, it's less. But one thing that's interesting is that the bond market prices are not proxying off those inflation rates on the long term. There might be short-term reactions to the number when it comes out, but clearly with a 5-year at under 12, the inflation benchmark is not really what's pushing those rates. Similar thing happened early last year. Early last year, long-term bond rates were significantly below inflation. So in this market, those two rates are slightly uncorrelated.
All right, and finally, Egie, we are seeing investors holding back, holding on to their positions when it comes to equities, still looking for whatever it is that are uncertainties within the market to be abating a little bit. And as a result, there's a sense that people may be moving into treasuries and government securities as a bit of a safe haven. Do you expect that position to continue for the longest while? And if not, what's needed to make the bond and money markets more attractive for investors?
Well, in terms of, yes, I guess for a lot of investors, the money to be made in this market has been made from the bond side, from the fixed income side. Equity markets, a lot of uncertainty around the banks until those banking recapitalizations are done, or that September deadline that the CBN gave for recapitalization passes. There's going to be a lot of uncertainty in that area. Most of the news in the market there hasn't been a lot of new news in the market. There's been a lot of news around the fixed income side, like the CBN lifting of the one-year rule, but on the equity market, not a lot of major market-moving news. So I guess the market is just trending downwards in the absence of any new information.